today, is inflation on the blink up again? Hello again, it's Martin North from Digital Finance Analytics, World Notice Post covering finance and property news. Well, last time, the FED Chair Jerome Powell said he was seeking greater confidence that inflation was moving back to 2%. Fed officials, of course, have a dual mandate to maintain price stability and maximum employment. And while the market is currently betting on a rate cut, with FedWatch currently reporting a 54.7% probability of a rate cut in June, the recent data releases are actually pouring cold water on that notion, as frankly, we've had nothing but bad news on the inflation front recently. Indeed, the latest consumer and producer price indices from the Bureau of Labour Statistics suggest that progress is stalling or possibly even reversing, so they won't be in a position to cut anytime soon, period. Thus, the likely decision in the next meeting will be to watch and wait again. For context, the Atlanta Fed's Sticky Price Index, which sorts the components of the consumer price index in the US into either flexible or sticky being slow to change, categories based on the frequency of their price adjustments. And they show a 4.4% read on sticky inflation, while the flexible CPI was down 0.2% last month, having been lower previously. And the rush of data on Thursday underscores the inflation problem, which is why yields went higher and stock markets fell. The S&P 500 fell 0.3% to 5,150, while the Nasdaq Composite closed 0.3% lower at 16,128, and the Dow Jones Industrial Average fell 0.4% to 38,905. And the all-important US 2-year bond yield was up to 4.7%. So turning to the data, retail sales rose 0.6% last month after falling a revised 1.1% in January, dragged down in part by inclement weather, according to the Commerce Department's report from Thursday. The value of retail purchases unadjusted for inflation rose by less than forecast in February after downward revisions to the prior 2 months. The so-called control group sales, which are used to calculate gross domestic product, were actually unchanged in February after falling in the prior month. The measure, which excludes food services, auto dealers, building materials, stores, and gasoline stations, suggests weaker economic activity so far in the first quarter. But overall, Americans picked up their spending a bit in February after pulling back the previous month. But last month's gain was weaker than expected, and January's decline was revised even lower, suggesting that many are growing more cautious with their money. February's number was also lifted in part by higher gas prices, as well as higher auto sales and a rebound in building materials costs, which were depressed by severe weather in January. Excluding sales from gas stations and auto dealers, sales rose 0.3%, and the national average gas price on Thursday was $3.41 per gallon, up from $3.39 a week ago and $3.26 just last month. Government retail data, of course, isn't adjusted for inflation, which ticked up to 0.4% from January to February, higher than the previous month's figure of 0.3%, according to the latest government reports. So retailers only eked out a slight increase after accounting for inflation. So while retail sales data might suggest some downturn in consumer spending, the latest data on inflation and unemployment filings will give the Federal Reserve even more reasons to hold off cutting interest rates. The Fed's preferred inflation metric, the Personal Consumption Expenditures Price Index, draws on key elements from the CPI and PPI readings. And the latest piece of data was prices paid to US producers, the PPI, released by the Labour Bureau of Statistics, which, by the way, often gets less coverage than the CPI series. The Producer Price Index for final demand rose 0.6% last month after advancing by an unrevised 0.3% in January, against expectations of the PPI climbing just 0.3%. A 1.2% jump in the prices of goods accounted for nearly 2/3 of the increase in the PPI. Goods prices were driven by energy products, which surged 4.4% after declining 1.1% in January. Goods prices had edged down 0.1% in January, and in the 12 months through to February, the PPI has shot up 1.6% after advancing just 1% in January. Even the narrow measure of PPI, which strips out food, energy, and trade services components, rose 0.4% in February after climbing 0.6% in January. And the core PPI increased 2.8% year on year after a 2.7% rise in January. And government data earlier in the week had shown that consumer prices increased strongly for a second straight month in February, but economists chose largely to shrug off the rise, arguing that difficulties adjusting the data for price increases at the start of the year continue to exert an upward bias on inflation. Certainly, wholesale gasoline prices rose 6.8% over the last month, and there were also heavy increases in the prices of diesel and jet fuel, but prices for hay, hayseed, and oilseeds fell, as did those for iron and steel scrap and asphalt. Food prices rose 1% amid increase in the costs of eggs and beef. Excluding food and energy prices, they rose 0.3%, matching January's gain, and that suggests that goods deflation, which has been the major driver of low inflation, has been drawing to an end, and services inflation would need to pick up the slack in easing price pressures. But services gained 0.3% in February, after rising 0.5% in the prior month. A 3.8% increase in the cost of hotel and motel rooms accounted for a quarter of the increase in services prices. But there are also increases in the cost of outpatient care, airline tickets, as well as securities brokerage, dealing, and investment advice, and portfolio management fees were up 0.2% after accelerating 5.9% in January. Portfolio management fees, healthcare, hotel and motel accommodation, and airline fares are among components that go into the calculation of the Personal Consumption Expenditures Index, the PCE, and of course the PCE price indices are the inflation measures tracked by the Federal Reserve for its 2% target. The so-called core consumer goods prices, which excludes food and energy, actually rose for the first time since May, while a similar measure at the wholesale level posted the biggest back-to-back increase in the year. Rising energy costs were a major factor in the outsized readings in both the headline CPI and the PPI, which came in above forecast in January as well. So the Fed will be likely to stay on pause for longer, also given the strength of the labour market. Applications for US unemployed insurance were lower than initially reported over the last year after revisions, notably for people already receiving benefits. A proxy for those people, known as continuing claims, was also revised down significantly at the end of February, as well as at the end of last year. Initial jobless claims were also marked down, but not by as much. That's according to the Labour Department data. So all up, economists at Nomura have pulled back on bets for cuts this year, seeing the first reduction in July and a second in December now, versus an earlier call for 3 cuts starting in June. But more and more are now wondering if rate cuts won't happen this year. At the moment, the incoming data will certainly pause the Fed's hand, and that in turn will make rate cuts in other markets more unlikely, which means the ASX rate tracker showing falls in rates locally later in the year could also be too optimistic. We'll see about that. But the point I want to make is that being so data dependent is actually quite significantly risky now, insofar that all of these data points that come in are going to push the Fed one way or the other. And frankly, being so data dependent and looking into the rearview mirror so far back suggests that the Fed's overall policy approach is probably flawed. The difficulty with data is it moves around. The difficulty with data, it contains lots of different elements that are pushing in different directions, and sometimes there are no clear underlying trends. So My take out of all of this is the following. The Fed is too data dependent and is not prepared to take a stand. And to that end, expect rates to stay higher for longer, whether that's the right thing to do for the economy or not. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.